report is out, and major parameters which has been released by Reserve Bank of India's financial stability report indicate that banking system is in safe hands. It is very much sound. And if you talk about the macro parameters which we watch every year, the macro stress test reveal that capital adequacy ratio of banks is likely to remain at 16.8% under the baseline scenario. Now, these are the tests which are conducted on the basis of adverse scenarios. There are three scenarios always. There is a base scenario, adverse scenario 1 and adverse scenario 2. And therefore, the capital adequacy ratio of the bank, which remained at 17.1% as on September 2025, is likely to decline to 16.8% under the baseline scenario. And if you consider adverse scenario 1 and 2, it is likely to remain at 14.5 and 14.1%. If you look at the other parameters, how banking system is assessed, the stress tests indicate that GNPA ratio, which stood at 2.1% as on September 2025, may fall to 1.9% in the baseline scenario. While if you conduct adverse scenario 1 and 2, it may rise to 3.2% in adverse scenario 1 and 4.2% in adverse scenario 2. But more importantly, the commentary which has come in from Reserve Bank of India governor is interesting, because he says that outlook for 2026 and beyond remain uncertain. He also mentioned about the global economy and financial system, which has faced several kind of challenges in 2025, but he mentions that stretched valuations of risk assets pose financial stability risk. He also mentioned that global financial system remains vulnerable and amid challenging conditions that needs to be watched out for. Now, to understand how's the financial stability report, we have two eminent guests, Mitali as well as Gaura Sen Gupta. Gaura, I want to come to you. When governor is speaking in the forward, which is there in financial stability report, he's saying that stretched valuations of risk assets pose financial stability risks. Your comments?
So basically, he's indicating that certain segments of the asset class is still elevated. For example, the equity markets, they have yet to show much significant correction. So one of the risks is that one of the reasons why India has not been able to attract FPI inflows and is actually seeing outflows is because our equity markets are seen as overvalued. The correction really never happened. So as a result, you are seeing a quite pressure on INR, and as well as the fact that our balance of payments is a large negative in FY26 because we're not getting the adequate capital inflows, which is putting the pressure on the RBI to supply those dollars, and which in turn is resulting in domestic liquidity drying up. So I think he's mentioning the fact that certain segments, certain asset classes, you are seeing elevated valuations. There's also another asset class, which is, let's say, gold, which has rallied, which I think has been the best performing asset class. And you are seeing more and more resources or investments that are going into the gold sector. So again, that is another asset class which is seeing stretched valuations.
Mitali, I want to come to you in terms of challenges. One of the challenges which has been focused in this financial stability report is stable coins. And now, governor says that growth of stable coins and private credit adds new layer of financial risk into the system. Do you think that 2026 is something which needs to be watched out for the same?
No, so thanks a lot for having me on the show. I think, there are a number of risks that have been flagged from an economic point of view. Of course, stable coins is just one of them, and so is, credit risk. But if we look at the overall macroeconomic scenario that the RBI governor has really spoken about, the global uncertainty really stands out as the main risk that has been flagged, and then everything else kind of follows from there. Because when you look at the geopolitical scenario, that is the mainline risk, headline risk that has really been flagged in today's discussion. And then you come to sort of asset classes within that accentuate that risk. Stable coins is one of them, private credit is one of them, but the main risk essentially essentially comes from the fact that we don't know how the geopolitical scenario is going to play out, how tariff risks are going to play out, how the macro economy is going to respond to these situations, and even the currency fluctuations are actually happening on account of these geopolitical dynamic changes. So I do think that the main risk which underlines this entire story is the geopolitical risk.
Hi, this is Ankita also joining in the conversation. Gaura, let me take a leaf from what you had mentioned that, the report also says that there is still a lot of geopolitical risk that persists, and also the fact that, the FPIs have been MIA as far as Indian markets are concerned. The valuations are still looking stretched. The rupee has been on a back foot. Now, getting into the new year, what would be your, view on the rupee? And also, because of that, a lot of other things that are linked, whether it is a trade deficit, whether it's the exports or the manufacturing that is getting impacted, how is that likely to play out?
So this year, the depreciation pressure on the INR, it's a capital account story. The fact that the BOP, in Q3, our estimate is that the capital account is likely negative. And the full year BOP till date the deficit is tracking maybe around $20 billion negative on a fiscal year to date basis. And this is basically because we are not getting the adequate capital inflows. This is a response, the investment pattern change towards India is a response to the fact that the rate of return on investments is relatively less compared to, let's say, other economies. And this is captured by that nominal GDP growth in India, which has reduced to, it's tracking at around 8% for this year. Last year, it was almost 10%. The year before that, it was 12%. And you build that moderation in rate, the nominal GDP combined with the fact that you've had a depreciation pressure on the INR, so the dollar rate of return on investments in India becomes comparatively less attractive, and that is getting reflected in terms of the pressure on the rupee as well as in the capital flow side. If you look at other EMs, let's say China, they have actually been able to attract FPI inflows in both equity and debt because their equity markets had actually corrected quite a bit. Now, going forward, the trade deal, we do see that as an incremental factor that is important from an exchange rate perspective. But in FY26, the lack of a trade deal has not been the reason why we saw depreciation pressure on the rupee. The depreciation pressure on the rupee is a capital flow story for FY26. But let's say if we do not get a trade deal, then that could be a negative for FY27 in terms of sentiment and could further add. So, in our expectation, we still feel that India will get a trade deal with the US. We expect the pressure on the capital outflow front to be a little more moderate next year. For us, our nominal GDP growth is picking up. We see it going to 10% in FY27. That should moderate some of the pressure. The other positive thing is that India may get included in the Bloomberg Global Aggregate Index, and nobody knows exactly, but there is an expectation that India could get included, and that can support FPI inflows into government debt in G-SECs. Basically, that will be quite a good support. India could get anywhere between $15 to $20 billion if India gets included in the Global Aggregate Index. The
Sure.
other factor is FDI is also picking up. It's gradual, but there is a pickup, and we expect that trend to continue into FY27. So we do expect the rupee to depreciate, but the pace of depreciation is expected to be softer.
Yeah, taking a cue from that, and good segue for my question to Mitali. The governor has painted like a robust and a resilient picture. How do you reconcile with the reality on ground? What are your reactions to that?
I think we have to look at the real economy versus what is happening in currency markets versus what's happening in the geopolitical space. These are three spaces which then interact in this financial stability report. So if we look at the real economy and we look at the GDP growth, India has again proven to be one of the fastest growing emerging economies in the world. We've seen, we've posted even a real GDP growth of 8%. I'm not talking about the nominal, but just the real GDP growth growth of 8 to 8.2% in this last quarter, far exceeding estimates. Now, why did that growth actually happen? That growth was driven so much by, I mean, of course, there was private consumption, but manufacturing growth was one of the biggest drivers of growth in the last 2 quarters. That came about because we were able to attract private sector investment for the first time in several quarters, even from the domestic private sector, which is talking about the overall sentiment, investor sentiment in the domestic economy. So that's the first. Second, we've been having consultations with several people in the industry who are talking about the fact that now that India is diversifying its own free trade agreement deals, and we're starting to see the FTA with New Zealand has already materialized. The FTA with Australia will also be coming in. We're negotiating the FTA with the EU. And of course, the UK-India FTA was the big story of this year. So this trade diversification is also helping the industry sentiment move away from only the US tariffs. So when you combine all of this, the real picture in the economy is actually a little bit different from what we are seeing in the currency markets.
Right. Mithali, point taken, and we're completely timed out on this discussion. Mithali and Gaura, thank you so much for taking the time out and joining us. But